Welcome to the deep dive. This week, we're cutting straight through all the noise, really getting into the nitty-gritty of the major Bitcoin and crypto ETFs.
Mm.
We're using the AI IntelliTrader's team analysis, looking at the data from market close, Friday, October 31st, 2025. Our mission, really, is to find those key signals, those patterns hidden in the numbers. We want to go beyond just price, understand where the money's flowing, the volatility, the technical setup. So let's jump right in with our, let's call it 60-second snapshot. Top 5 by volume and 4V rank. And right away, one name just dominates.
Well, absolutely. IBIT. The iShares Bitcoin ETF, the volume figure is, well, it's kind of staggering. 46,808,750 shares traded.
46 million. That's not just leading, that's a whole different lead.
Exactly. It sets the entire structure. At $62.30 a share, this is clearly the main conduit for institutional capital in the Bitcoin space right now. That scale, that sheer size, it allows huge funds to move millions without, drastically shifting the price against themselves. It is liquidity for this asset class.
And if you mentally pull that number out, the rest of the field looks, well, much smaller. The next 4 combined don't even touch it.
Not even close. You've got FBTC next, Fidelity's offering, that's 4.6 million shares. Then ARKB, the ARK21 shares, 4.3 million. GBTC, Grayscale, 4.2 million, still significant, of course. And then BITB, Bitwise, rounding out the top 5 at 2.4 million.
So IBIT is trading about 10 times more than its closest competitor on that day.
Roughly, yes. It just shows where the bulk of the, let's say, actionable high-frequency capital is choosing to operate. It's a very clear preference.
Okay, so that's the volume picture. Now let's layer in that initial look at implied volatility rank, the 4V rank. What are options traders thinking about future swings?
Well, there's a definite trend among those big volume players. For most of them, IBIT at 54%, FBTC 49%, GBTC 48%, BITB 46%. The indicator is DN-word.
DN-word, so downward trend in expected volatility.
Precisely. It means traders are pricing in less potential for big price moves going forward. Suggests the market might be compressing, maybe settling down a bit. Could be seen as consolidation or even maturing. It generally favors strategies that sell options premium.
Getting less jumpy overall, but there's always a but, isn't there? There's an exception right there in the top group.
There is. ARKB, the ARK21 shares ETF. It's showing 50% upward.
Upward. So while most expect things to calm down, ARKB traders expect more action.
That's the divergence, yes. It signals that for this specific fund, traders are actively pricing in more expected movement. Could be speculation, maybe something specific to ARK's strategy or flows. Hard to say for sure, but it's telling us that options are relatively more expensive there because the expectation of a swing is higher. Volatility isn't dropping everywhere.
Okay, that contrast really sets the stage. We can't just look at price or volume alone.
No, definitely not. We need to dig into the sustainability of that volume. The technical picture, those moving averages, true value, and really crucially, who's actually pushing the buttons?
Yeah.
The buyers or the sellers.
Right. Translating all this data into something useful, actionable intelligence? Is this market building strength just consolidating or maybe setting up for a fall?
That's the goal. Let's get into it.
Okay, section 1. Let's circle back to IBIT. That massive volume, 46.8 million shares at $62.30. You said it's the default. Was Friday just a fluke, though, or is this level of activity normal for it?
The analysis says it's persistent. Very enough so. Friday's volume was 81% of Thursday's. And maybe more importantly, it was 96% of the volume from the week before that.
The 96% week over week. So this isn't a spike, it's just the baseline now.
It seems to be. This is sustained, reliable, repeatable high volume. And that's gold for institutions. They need to know they can get in and out of large positions without causing massive slippage, without their own trades moving the market too much.
So that consistency reinforces its position as the leader, the low-friction choice.
Exactly. It breeds confidence.
All right, so IBIT is the steady giant. Now, shifting gears slightly, market sentiment at the open on Friday. The data shows something pretty incredible, almost like everyone agreed overnight.
It's quite striking if you scan down the open gap column in the report. You see gap up almost everywhere. IBIT, FBTC, ARKB, GBTC, BITB, HODL, BRRR, BTCO, EZBC, BTCW, pretty much the whole list.
A universal gap up.
Yeah.
Walk us through what that means. Why is that significant?
It's a very bullish signal for the start of the trading day. A gap up means the opening price was significantly higher than where it closed the previous day. It implies that overnight, or maybe due to some news, buying interest built up so much that it basically absorbed all the sellers before trading even officially began. The first print of the day was already higher.
So immediate positive momentum. Everyone wanted in right at the bell, willing to pay more than yesterday's close.
That's the implication. Strong conviction right out of the gate.
Now, of course, there's always an outlier. DeFi, the Hashdex ETF, was the only one showing a gap down. We'll definitely need to circle back to DeFi later. It seems to be marching to its own drum.
Yes, it's technically quite different in a few ways. But setting DeFi aside for a moment, we hit maybe the most fascinating technical point in the whole report. It was a real contradiction, and you really need to wrap your head around this one. The moving average positions.
Okay, let's start with the long-term picture. What's the big trend saying?
The long-term trend looks solid, really solid. Every single ETF analyzed is trading above its 200-day moving average.
The 200-day MA, that's the classic long-term bull-bear line, right?
It is, widely watched. Being universally above it means the primary structural multi-month trend for Bitcoin exposure is firmly pointed upwards. This underpins why the daily power trend column mostly shows M trend, medium trend. There's strong underlying momentum.
Okay, so the foundation is strong, the house is built on solid ground, but you mentioned a contradiction. Something less rosy, maybe?
The contradiction comes when you zoom into the shorter time frame. This is where the current battle is happening. While everything is comfortably above the 200-day MA, nearly every single ETF is simultaneously below its 200-hour moving average.
Above the long-term average, but below the much shorter-term one. That's a conflict. What does that specific split tell a trader?
It really defines this particular moment in the market. Think of the 200-day as the climate. It's sunny for the year. But the 200-hour is the immediate weather forecast. And right now it's cloudy, maybe even stormy, or at least hitting resistance. The price is under short-term pressure. The last, say, 8 or 9 trading days, roughly 2 weeks of hourly data, have seen enough selling to push the price just below that 200-hour line.
So the gap-up energy we talked about, it hit a wall.
Seems like it. It hit that 200-hour resistance. So the market is in a serious consolidation phase. Long-term bulls are okay based on the 200-day, but anyone trading shorter time frames is bumping up against significant resistance right there. Until the market can convincingly break through and hold above that 200-hour MA, it signals that while the overall trend is up, the immediate path higher is blocked. Momentum is capped for now.
So a long-term uptrend pausing, hitting its head on near-term supply. If you're watching the charts, that 200-hour level is the key battleground.
Absolutely. It's the technical hurdle to clear for continuation. And again, we have to mention DeFi. It's the only one that's above both the 200-day and the 200-hour.
Really? So DeFi has the strongest short-term technical posture of the lot.
Based on these averages, yes. Which is interesting given its low volume and that gap down. More on that later.
Okay, let's shift focus to risk and valuation. Revisiting the high V-rank trends. We said most big names, IBIT, FBTC, GBTC, BITB, are DN-word. Volatility expectations are falling.
Right. That compression, the DN-word 5 rank, suggests the market sees less uncertainty ahead in the near term. This tends to make options cheaper, relatively speaking. So for traders using options, it might be a better environment for strategies that benefit from time decay or stable prices, like selling covered calls or cash-secured puts. It indicates a move towards, perhaps, more efficiency.
But we have those outliers showing rising volatility expectations, places where the market is pricing in potential fireworks. ARKB was 50% upward, and you also mentioned the micro Bitcoin futures contract, MBTX 25.
Yes, the futures contract is also showing upward 5E rank at 47%. When you see specific instruments like ARKB maybe reflecting its specific holdings or flows, and especially the leveraged futures contract lighting up like this, it suggests targeted speculative interest. Futures inherently have more bang for the buck due to leverage, so traders anticipate bigger swings and are willing to pay a higher premium for options that capture that. It tells us that while the core ETF market seems stable, the edges ARKB and especially futures are where the speculative heat is concentrating.
Interesting distinction. Okay, let's move to the daily true value column. This metric tells us if these ETFs are trading at a fair price or if they're stretched based on daily price action and volatility. What's the general picture here?
This finding fits perfectly with the moving average story we just discussed. The consensus is pretty remarkable, actually. The vast majority, IBIT, FBTC, ARKB, BITB, BRRR, EZBC, BTCW, basically the heart of the market, are all calculated as being 1% undervalued on the daily time frame.
1% undervalue. So after that gap up met resistance at the 200-hour MA, the selling pressure was just enough to nudge prices slightly below what the AI considers fair value.
That's exactly how it looks. It's not a deep discount, not a fire sale. It's very slight. It signals that the initial bullish push was met and absorbed, bringing the price back to an equilibrium point, just fractionally undervalued. It really confirms a technical standoff, a market balanced on a knife edge, right near resistance.
But then we have the outliers again, showing significant mispricing. BTCO, the Invesco Galaxy ETF, trading around $109, it's flagged a 6% overvalue. That seems like a lot.
It is quite a bit, yes. And that's our first real flashing red light regarding potential inefficiency. Why would this one fund trade 6% above its calculated fair value when all its high liquidity peers are right around fair value or slightly under?
What could cause that?
It could suggest a few things. Maybe there's concentrated demand hitting this specific lower volume product. Or perhaps the underlying price discovery mechanism for BTCO itself is just less efficient right now, maybe due to how its NAV is calculated or traded. Either way, it means you're paying a significant premium to get Bitcoin exposure through BTCO compared to others.
An expensive ticket, as you said. And then the futures contract, MBTX25, that's showing 12% overvalue. 12%.
Yeah. Immense, isn't it? That's almost purely driven by speculative anticipation and the time premium embedded in futures. Futures contracts always reflect expectations of future prices. A 12% overvaluation suggests very aggressive bullish bets being placed, looking towards the X25 expiry. Speculators are basically rushing in, paying a hefty premium now to lock in leveraged exposure, anticipating a significant upward move. It's a stark contrast to the spot ETF market consolidating disciplinedly, while the futures market is inflated with high expectations.
Before we move on, just a quick note on the squeeze data columns, daily and 1 hour. They seem mostly blank or have dashes.
Right, and that absence is information too. A squeeze signal fires when price coils up very tightly, suggesting a big move is imminent, either up or down. The fact that we're not seeing squeeze signals, despite the gap up and the volume, tells us the market isn't quite at that explosive compression point yet. It supports the idea of controlled consolidation rather than immediate volatile breakout brewing on those timeframes.
Makes sense. Okay, that's a great overview of the value and volatility picture, and it provides excellent context for what we need to tackle next. The actual trading pressure, who's winning, the buyer-seller battle. Just before we dive into that, a quick reminder. If you are enjoying these insights and detailed breakdowns, make sure to hit that follow button and turn on notifications so you're the first to get our market analysis update every week. We really appreciate the support.
All right, let's get into what seems like the most contradictory piece of data yet, the buyer versus seller direction. Okay, section 3. So let's recap the narrative. Long-term trend is up. Above 200-day MA, we had that bullish gap up, and then price hit a wall below 200-hour MA and settled slightly undervalued, 1% undervalue. This next piece of data feels like it shouldn't fit.
It does seem counterintuitive at first glance, yes. This is probably the most crucial finding to understand the current market dynamic. When you look at the daily and weekly buyer-seller direction columns across the board, the signal is almost universally seller UP. Seller UP, we really need to unpack that. How can you have a universal gap up, suggesting buyers are eager, but then the dominant pressure throughout the day and week is from sellers pushing up?
It's key to understanding the nature of the resistance. Seller UP doesn't mean sellers are panicking and hitting bids lower. It means sellers are disciplined. They are placing their sell orders higher up, meeting the buyers as the price tries to rise. They aren't chasing the market down. They're effectively building a wall of supply above the current price. Think of it like an auction where every time a buyer bids higher, another seller immediately steps in, willing to sell at that new higher price. They're absorbing the buying pressure.
Okay, so the gap up provided the initial buying surge, but sellers were waiting right there, ready to distribute into that strength. They're controlling the top edge of this consolidation range.
That's exactly the picture it paints. This persistent, disciplined selling pressure is why the price failed to hold above the 200-hour moving average and why it settled back down to that 1% undervalue level. The sellers are actively capping the rally for now. They're meeting every attempt to move higher with supply.
Wow, okay. That clarifies the dynamic considerably, but of course, there are exceptions to the seller UP rule. Let's talk about BITB first. Daily direction is seller UP, same as the others, but the weekly direction is flagged as load-in UP.
Yeah, load-in UP is the AI's specific term for significant aggressive accumulation over the weekly time frame. It's a strong signal. It means that despite the daily selling pressure we just described, when you zoom out to the whole week's activity for BITB, there was substantial buying, likely institutional, quietly absorbing that supply. It suggests hidden strength, underlying demand building up, and this lines up perfectly with BITB's weekly volume ratio, which was 124% compared to the week before. So more volume, and the analysis says it was accumulation. BITB seems to be attracting serious buyers beneath the surface noise.
Interesting. So a divergence between the daily noise and the weekly trend for BITB. What about the other main exception, the futures contract, MBTX 25? Its daily direction is buyer down, while its weekly is still seller UP.
Buyer down is different. It suggests a different kind of urgency. Here, buyers weren't waiting for the price to come to them or pushing it higher. They were actively hitting the bids, buying contracts as the price was descending during the day.
So more aggressive buying on the way down.
Yes, it implies a rush to get positions on, perhaps defensively, scooping up contracts at lower levels within the day's range, maybe anticipating that the dip wouldn't last. It's less about meeting sellers high, more about grabbing exposure quickly as it momentarily weakens. Still buying, but with a different tactical feel compared to loading UP.
Okay, let's connect this back to volume sustainability using the volume ratio analysis. Are these volumes building or fading?
Right, we look at the daily ratio, today versus yesterday, and the weekly ratio, last week versus week before. We already mentioned BITB's strong 124% weekly ratio suggesting growing interest. HODL, the VANIC ETF, also showed good sustained activity with a 110% weekly volume ratio. These funds are seeing genuine growth in participation.
But then there's that daily volume number for DeFi again. We know the absolute volume is tiny, just 3,180 shares, but the daily ratio is 421% of the previous day.
It's a massive percentage jump, clearly flagged as unusual activity. Now, you have to remember the low starting point. A couple of decent-sized block trades could cause that kind of percentage spike on such low absolute volume.
So it doesn't necessarily mean broad market interest surge.
Probably not. It more likely points to one or a few specific motivated players making moves in DeFi on that particular day. It signals high concentration, maybe a high conviction trade, but not necessarily widespread participation. It does mean DeFi could be volatile if that specific activity continues or reverses suddenly.
Got it. And on the flip side, we have BTCO showing volume contraction. Only 52% of the previous week's volume traded last week.
Yes, and this really adds to the cautionary picture for BTCO. We already know it's trading at a significant 6% premium over value. Now we see its liquidity is actually drying up. Activity cut almost in half week over week.
That sounds like a risky combination.
It absolutely is. Lower liquidity makes the existing premium even more precarious. It increases the risk for anyone holding it, especially in size. If sentiment turns, getting out cleanly could be much harder compared to, say, a beat. The illiquidity risk is concentrated there right now.
Okay, section 4. Let's really zoom in on these outliers now, the ones operating outside the main pack. Starting with BTCO, the Invesco Galaxy Bitcoin ETF, trading at $109.40, flagged 6% overvalue, very low daily volume, around 124K shares, and that volume is contracting fast 52% weekly ratio.
BTCO really stands out this week as, well, potentially inefficient. That 6% premium seems directly linked to its low trading volume. It's like a scarcity premium. When fewer shares are changing hands, any moderate buy order can push the price further away from fair value because there just isn't enough supply offered at closer prices. For anyone looking at this space, you have to weigh that combination, paying more than fair value for an asset where liquidity is actually decreasing.
So the lack of trading activity is inflating the price relative to its peers.
That appears to be the case, yes. Unlike YIBIT, where massive volume keeps the price efficient, here, the lack of volume seems to be contributing to the distortion. It's a higher risk proposition if you need to trade in or out quickly.
Okay, now let's dissect DeFi, the Hashdex ETF. This one's the real technical maverick this week. It was the only one with a gap down at the open.
Right. Suggests some negative pressure specific to it right at the bell.
But it's the only one currently holding above the 200-hour moving average.
Which is fascinating. That gap down implies maybe some localized selling or concern. But whatever happened after the open showed significant resilience. It's the only fund that managed to clear and stay above that key short-term resistance level that's pinning down all the others.
So despite a weak open, its actual trading performance and short-term technical picture are stronger than the entire rest of the field.
Based on this key moving average, yes. It demonstrates superior short-term technical strength right now. And this is reflected in its daily power trend being marked H trend, likely for high trend, while everyone else is M trend. medium trend.
And that connects to the 421% daily volume spike.
It seems connected. That unusual activity, even on low absolute volume, coincided with it pushing and holding above the 200-hour line. It suggests a very targeted, high-conviction move by someone drove both the volume spike and the technical breakout, completely against the consolidating behavior of the broader market.
A very peculiar situation for D5I. Okay, finally, the futures market. METX 25, the micro Bitcoin futures, trading equivalent to $110,135. The huge story here is that 12% overvalue status.
12%. It's just a massive premium. This is the price of leveraged expectation, pure and simple. The futures market is where traders place their bets on where things are going, often with leverage. Paying 12% over the calculated spot value is a very aggressive bet on near-term upside. It shows intense bullish speculation is concentrated in the futures contract for that X25 expiry.
But despite that premium and high daily volume, 114% of the previous day, its daily power trend is listed as N trend. Neutral, how does that work? High price premium, high volume, but neutral trend.
It suggests a disconnect. Speculators are piling in, driving the price of the contract way up relative to spot, but the actual technical price action of the contract itself may be more sideways or choppy on the day. It's like the market is priced for a rocket launch, but the rocket is still sitting on the pad, technically speaking. The premium reflects extreme anticipation, but the immediate chart pattern isn't yet confirming a strong directional move. It's pure speculative tension.
All right, let's wrap this up. Time to synthesize all this data from the AI IntelliTraders team for the week ending October 31st. What's the big picture?
The core message is one of, I'd say, tense consolidation built on a strong foundation. The long-term bullish case, supported by everything being a long down, above the 200-day moving average, that's still very much intact. The week started strong with that universal gap up. But that bullish energy immediately ran into a significant wall of resistance, evidenced by the price staying below the 200-hour MA and that pervasive seller UP pressure.
So the sellers absorbed the initial punch.
They did, and it resulted in most funds settling right around fair value, maybe slightly under that 1% mark, basically grinding sideways beneath that key short-term resistance.
So the market isn't breaking out, but it's definitely not breaking down either. It's coiling, maybe? Consolidating energy?
That's the key question this data poses. Which leads us to the final thought, the provocative question for you listeners to mull over this week. We have this clear split signal. Rock-solid, long-term support from the 200-day MA, but persistent, heavy short-term resistance at the 200-hour MA, coupled with that seller UP dynamic. How do you interpret this consolidation? Is it just a healthy pause? A classic bullish pattern where the market catches its breath, builds energy like a coiled spring before the next leg higher, trusting that 200-day support? Or is that overhead resistance, that disciplined selling pressure we identified, simply too strong right now? Does the market need a major catalyst to break through? Otherwise, it risks eventually rolling over from this consolidation.
That's the puzzle, isn't it? Trust the foundation and buy the consolidation, or wait for the confirmation, the break above that 200-hour line.
Exactly. Watching how the big players, especially IBIT, behave right at that 200-hour level in the coming days should offer some clues.
An excellent framework for thinking about the week ahead. And if you found this deep dive valuable, remember we do this every week. Make sure you hit that follow button, turn on notifications so you don't miss next week's analysis. Thanks for diving deep with us.